You guys have probably heard about the Feds potentially lowering rates here in the near future, maybe even as soon as next month, but at least one, maybe two, three times, depending on the report you're looking at throughout the year of 2024. And a lot of people are asking, what does that do for me if I'm in the middle of trying to buy a house? If I'm pre-approved, should I wait? Should I go into contract closer to when the Feds potentially are going to lower rates? I wanted to kind of address how that works. Also for people that are looking to refinance or debt consolidate, what does that look like? And again, should you wait or not? We have to kind of understand where that Fed funds rate actually comes from. So that Fed funds rate was raised recently on a pretty sharp scale to basically slow down consumer spending. And it really wasn't working. There was a lot of people out there still spending, putting money on credit cards, buying automobiles, you name it. We're all, consuming. And part of that's because we came from a period of being locked down for a little while. And so we actually just consume maybe just a little bit too much. Kind of like if you were hungry for too long and then all of a sudden you had a buffet in front of you, you probably eat a little bit more than you probably should, right? And you're going to feel a little bit too full. That's kind of what's going on in the economy right now. And if the consumer spending slows down too much, then what happens is businesses have to start to lay off people. So you have job losses. So to preserve the jobs, the Fed's looking at it now saying, okay, let's make sure that we don't fall off a cliff with consumer spending. We got to keep this economy going. We're going to go ahead and we're going to lower the cost, the borrowing cost to the bank, the Fed funds rate, the money we're going to lend to the banks to lend out. We're going to lower that percentage just a little bit in the near future so that they can kind of keep things at bay, right? We can keep people actually employed and we can keep people spending. Now, that means that inflation's coming down just a little bit, but it doesn't necessarily mean that we're going to have these incredibly record low interest rates like we had in 2020 and 2021. It just means that we're going to start to see things roll back down a tad. Now, the Fed funds rate, when they come out and they say, hey, we're going to cut it 0.25% or maybe more aggressive, we're going to do a 0.5% rate cut. It doesn't mean that mortgage rates now are going from say 7.25% to 7 or 7.25% to 6.75. But they may eventually start to drive down because it's a good sign that inflation's starting to cool. Inflation is kind of the arch enemy or the kryptonite, if you will, of a mortgage rate. So if inflation's really high, mortgage rates are going to be high. If inflation's really low, mortgage rates are going to come down as well. You got to remember, like, these mortgage rates are being lent out to you for decades. I give you a loan for 30 years, you got 30 years to pay that back. Well, the bank is committing to only picking up, 6-7% interest on that loan. And if inflation is running at 7-8-9%, then they're losing money on that, right? The money that they lent out to you that they're not going to recover for 30 years is actually being eroded by inflation. In a weird way, it's actually why we want to take long-term mortgage loans anyways, because our long-term mortgage loans are being eroded by inflation anyway. So any of you that got loans back when they were 2, 3, even 4%, inflation's really just wiping away that debt over time in kind of a weird way if you were to kind of break it down that way. So my point is, with all of this, when the Feds come out and they say, hey, we're going to lower rates, you don't need to time it. It's going to be a gradual decline. We see mortgage rates come down. It's not like they're going to jump from 7.25% down to 4%. They're not going to do that overnight. They're going to do that over a long, steady transition lower. When this has happened in the past, we watched people that not only bought but refinanced, and they tried to time it and kind of waited a little bit. But the smart ones actually kind of just do it gradually. So if you had a 7.5% interest rate and mortgage rates now are at 6.5% with no points and no cost, if your lender can give you a no-cost loan, rewrite it. You save a whole percent on it and didn't cost you anything, and we didn't stack additional years on your loan. That's a smart way to do it. Then when the rates go down again, they're 5.5%, do it again. If they hit 4.5%, we get lucky there, then do it again, right? So you're going to kind of refinance multiple times along the way down. Each time you're kind of saving a certain amount of money. We call that a strike price in our office here. So we actually will monitor that for you. If you have a mortgage and you kind of want to know, like, when's the right time for that, we want to jump on a call. We can calculate out a couple of things, figure out what the right strike price is for you. We can set some monitors on the back end. We'll watch it for you. Same thing for debt consolidation. Maybe we need to know, like, when the rate hits a specific amount, so your payment's here, and you can tap into your equity by $100,000 to consolidate all your debt and save a ton of money on what you've got going out every month. We can do that as well. So some really cool things we can do there from a mortgage and debt management. And it's all going to kind of tie into what's going on with the Feds and how they're going to start to react to what's going on in the economy. So stay tuned. Some really interesting stuff here in the next couple of months. Any questions that you guys have, or you want us to kind of work up a strike price for you on the purchase or on a refinance, reach out. We'll spend some time with you.